2 minutes past 7. It's on Monday, and this is a course for GFI clients. I'm Kobus from Cape Town, GFI Cape Town, and I'll be sharing some Fibonacci with you tonight. Just a few admin again before we start. Alright, Ian, I'll just go along. Audio is not as hot, so you can just log out and log in again. I'll just continue. Alright, going to our Facebook page. We've got a new page, African Forex Lounge. You can go and join there. As I always say, go and register on ACM Gold on their website. Go and open up a demo account. Go to Forex Blue of FX Blue, and we participate in our competition, our demo account competition, which you can win live prizes and a welcoming tool that we can see which traders can trade the best and how we stand. Alright, we've got our new website as well. Go to gfiafrica.com. That is GFI Africa. That is one word, gfiafrica.com. If you guys don't have live accounts, we actually went out to ACM Gold and we struck a deal with them. If you open up an account through GFI, we will give you a bonus, and that bonus is everything between 5% up to 25%, depending on how much money that you invest with. So let's say you invest, let's say $10,000, and you qualify for a 20% bonus. You put in your $10,000 and the account will show $12,000. So please go to gfiafrica.com so that you can open up your live account through us. And after you've done that, please send me your detailed account number so that I can just speak to ACM so that bonus goes through to you guys. Alright, gfiafrica.com. That is a welcome tool from ACM. They're on Africa. That's the biggest broker in Africa as well. So that's a very, very nice tool that we have to use. Just send me those details through Facebook or whatever so that we can open up that bonuses for you. Remember the competition, and then we'll get started with Fibonacci's. Any questions up to now? All you guys happy? I see Ian is back. Audio ready? Everybody happy? Right, we're moving along. Alright, how Fibonacci works is mathematical sequence. It is golden ratios in the market. It isn't just only in the market. If you go and Google Fibonacci, you will see there's a lot of examples there how Fibonacci works. Here's the financial or the mathematical sequence. We've got 1, we've got 2, then you add 1 and 2, you get to 3. Alright, 1 and 1 is 2, 1, 2 and 3. Then you add 2 and 3, you get to 5. 3 plus 5 is 8, and so you've got your mathematical sequence here. 1, 2, 3, 5, 8, 13, and so you go along. 8 plus 13 is 21. 21 plus the previous one is 34, and so you go on to infinity. And then if you divide the numbers, you will get to mathematical or Fibonacci ratios we will use in the market. And if you go Google, there's a lot of examples how the Fibonacci, we can see it in nature, we can see it in our faces. Our faces got Fibonacci ratios in them, our bodies got Fibonacci ratios in them. Alright, and the one that I want to go down with, or we'll start cracking, is that what we will use in the market, our ABC. And I will show you an example in Fibonacci how that works, and we'll go into the live market and see where we will get that and trade from there. Alright, let me just quickly see where it is. Fibonacci is invisible or not visible to the eye support and resistance zones in the market where we can buy and sell. Alright, there's one. We're going to use this example, ABC. We've got the beginning of a swing, we've got an uptrend, and then we've got the retrace. We want to buy that market in the uptrend on a Fibonacci level, and we will have our target that we aim. So that's our ABC, and obviously our D will be our target. So that we will go look in the market for. Alright, we have Fibonacci on our software. This little tool here, the F there, Fibonacci retracement. If I put it down there, there is the Fibonacci levels that I use. We've got the 38.2%, the 50%, the 618%. Those are the three main Fibonacci levels. I just add one, the 786%. That is also a 786 is also a Fibonacci retracement level. So that is hidden support and resistance zones in the market, which we can use to trade from. I use only those main three plus the extra one. The extra one is for extra deep retracement levels. In other words, the market starts here at the top. That's our A. We go down to B, and now the market is retracing. We want to sell our C level. So that's our A. That's our B. And this is our C. And a bear market, we will be aiming, and we will show you where the target of D is. Alright, so that's our ABC. In a bear market or an impulse from A to B down, we must wait for a retracement level to sell this, stops above A, and we'll be targeting D down here, which will be determined now. Alright. I'm going to start with the British pound first, because that is a very nice one. The last few weeks I am in total sequence, or in total unison with the British pound at the moment. Guys, just one thing that you must remind yourself is, if you don't know what is going on the market, the specific currency pair, you can leave that currency pair and you go to the following one. If you're not in unison with the Aussie dollar or the British pound or the Japanese yen, you leave that currency pair and you go on to one that you feel comfortable with. There's many times that traders come to me and ask me questions about certain currency pairs, and I will just tell them I don't know. I don't know in which direction the market is going. I don't know what that currency pair is doing. I'm not in unison with that pair. Now, the British pound lately is one of my favorites, because I know exactly what this pair is doing at the moment. And I will trade the British pound in the direction of the trend as long as I know in my heart what that currency pair will be doing according to my technical analysis. The Canadian dollar is a bit risky for me at the moment. I've got an idea or some setup that I know that it's going to do. The New Zealand dollar, I'm totally not in sequence with this. I don't know what it's going to do next. So I leave the New Zealand dollar for now. I'm sticking with the currency pairs that I'm comfortable with, that I can see what I'm working with is working. Alright? So let's start when we see a market is turning, and how we will use the Fibonacci's. I'm just looking for an example here. You guys know that I don't often prepare my charts. Alright, here's one. Alright, let's delete this. Right. Guys, remember when the market is turning, or the impulse? Do you guys remember what an impulse is? An impulse is in the direction of the trend. It's a very strong move. Alright, this is from the lows. A strong move to the upside, or a bull market. And now the market is retracing. We know, if you go and look to the YouTube video, we know that corrective waves are overlapping. Alright, something like this. So we know that the bull market has got an impulse, and now we're retracing down, and we know it's corrective waves because the market is overlapping. The highs and the lows are overlapping each other. We know this is a bull market. Now you draw your Fibonacci's. is from the start of a move, you draw it up to the high, and now we know that we are retracing and we want to buy most of the time the 618%. Right, rule number one, we've got the market that turned, right, so we're bearish here. Market came down, we have a low here, let's call that low A. And now we see an impulse or a strong move to the upside, and we know that that market has turned. It's a bullish market, and we see the retracement to the downside. We want to buy C. Right, so that is our high. And the rule is you buy the fib zone, and the fib zone is on the 618%. Right, I'll go into that now, Ian. And we've got C there. Alright, so that's how Fibonacci works. That's how you draw in your tool in direction of the trend from A to B, and you buy on the fib zone, the 618%. You buy that market. Obviously, we'll put in some indicators just now. Buy the fib zone, and you target the bullish market, and we will determine the target now. Stops will be 50 pips below A, or the start of our bullish market. In other words, if this low is taking out, we know that our bear market has just continued and we're out of that market. You don't want to stay in this bullish market. If you buy the fib zone and this market goes beyond A, then you know that it is over. You must get out that trade. The bearish market or the bears just took over and they are still in control. Right. Ian says we're on the monthly chart, we're on the 618%, correct. Alright, so let's see the euro here. This is a monthly chart. Guys, this is a impulse or a bull market. Here's an example. Look how this bear market ended here at the bottom. Alright, if we mark it here with an A, down here, that is our A. We'll get into more advanced stuff just now. And we've got our B here at the top. That is the high of our bull market. Thanks, Ian. This is a nice example. Our Fibonacci, we will draw from the bottom to the top. And we can clearly see we're already past the 618%, or we're basically on it now. Alright? So for the guys that believe or trade long-term trades, like George, he's a long-term trader, this will be an area that he would like to buy the euro in, and he will target much higher because he's a long-term trader. Obviously, we are in the fib zone. That is our first thing that we see, or first step. Step number 2 will be to put in some indicators to see if we're oversold in that market. And step number 3 is to buy this market if we get some candle information, which is our candlestick patterns, then we will buy that market. Alright, so there's a nice buy on the euro for the guys that trade long term. We're in the fib zone. Obviously, when you buy the market here, your stops will be below A. So this is quite a big stop, guys. This is for long-term traders. I don't suggest. I'm really not a monthly chart trader. I look at the monthly chart to see in what direction we want to move. Alright. Look at this example here. We've got a down move. That's our A. We're working in a bearish market. We've got a low down here, which is our B. And now we draw in the Fibonacci. Let's delete that one. This is a weekly chart. We draw the Fibonacci in the direction of the trend, and we see that market almost went up to the 78.6%. Above 618, we're in the fib zone. We can sell there, and we will obviously target much lower. Alright, so we sold C. Is everybody familiar with the ABC situation? And is everybody happy with the fib zone, which is around the 618%, or I will buy or sell just 10 pips before the market has reached the 618%? Everybody familiar with that? Guys, some of the the currency pairs, the British pound dollar pair is very often that guy goes to the 78.6%. That's why I've got it there. It's even a deeper retracement level. It gives you even a more risk reward, better risk reward. So I'm looking at the 618 and the 786.6% retracement level. There's where I'm selling or buying, and we will get to the targets now. Alright, everybody happy? Here is some advice for you guys. When the market starts, in other words, where the market turns, 80% of the time it will go to the 618%, and that's why we buy and sell the fib zone. When the market has gone and has just continued, in other words, in this example, let's delete that. This market has turned at the top. We're still in an impulse down. Rule number 2 is we've got the fib zone. The market will only retrace to the 38.2% if the market has gone and fall from there already. Alright, so let's put in our Fibonacci's from the top to the bottom. You will see that retracement here is not as deep as the euro example there. This one. When the market turns, it will go back to the 78.6%, but if the market has gone for a while, it only does shallow retracement. I will teach you guys in the following next sessions in the advanced courses about Elliott wave, and you will see here that we've got a high there, we've got an impulse down, and look at this market, how it retraced only to the 38.2%. So that's the golden thing that you can remember. If you've got a swing, if it swings here, it will go to the 618%, but if it swings lower, it will only go to the 38.2%. 38.2% is in a market that is fast. It only does shallow retracement. When the market turns, it makes deep retracements. Let's go to the Japanese yen. That's a very nice example as well, to just put my point across. If you look at this start of the bullish market here at 75.50, look how deep these retracements are. If I put in my Fibonacci down here, if this on the right side from 2 to 3, if this market didn't happen yet, and number 1 was my high, alright, so that was my high. Look how deep 2 was. 2 was to the 78.6%. In other words, that is our A, that was our B, and we want to buy C. See how deep it is, that I can buy the 618% or the fib zone, and I will go to my targets down here. So when the market turns around, it will retrace deep to the Fibonacci level. But as soon as the market is gone and that Fibonacci level is tested and we pass 0.1, then it will only retrace 38.2%. So let's test that. Alright, I put my Fibonacci into the last swing from my 2 to my 3. Alright, and see how this market only tested the 38.2%. I didn't teach this in the beginners class as yet because this is an advanced course material, but as we go along we will go more and more to the advanced stuff. Alright, so this Fibonacci 1, let's call it Fibonacci 1, had a deep retracement because it was the beginning of a bull market, and as soon as the bull market breaks that one or the resistance from there, the market ran and only came down to the 38.2%. So that is very familiar in territory in the market. Let's work with our targets. You can write this down. Fibonacci targets. If the market retraces to the 618% of the swing, you can target the extension of the 1.618. Retrace the first retracement to the 618%, you can target 1.618. and if the market only retraces to the 38.2%, you can only target the 1.27%. Alright, so write that down. 618, you can target this 1618 or the 2618. I will get to that now. And if the market only does shallow retracement, you only retrace or target the 1.27%. So let's put that in our analysis and see how that works. Alright, so I'll add both of them. 1.618. We'll add a 1.27. I will explain this and I'll just pause for a while to get some questions. And I want to add this one. I want to be a little bit... Alright. Remember, if you add the extensions, your extensions will draw in the opposite direction, so please bear with me. Your targets will then be in reverse. In other words, you will draw it against the market. So if this is my... Let's delete this. I don't want to confuse you guys. Alright, so let's make this as our B. And this is our C. And obviously we start here at A. Am I going too fast for you guys? Everybody still with me? So forget all the other stuff that's on the chart now. That is smart trading stuff. You will get to that. I will teach you that as well. We're just working with the ABC here. We've got the low on 75.50. That's the start of our bull market. We're looking for a retracement to see which we buy, and we saw that it was on the 618% fib zone. We buy that market and we target the 1.618, and we draw it in the opposite direction, and there we can see that market reached the 1.618 and even went past that. Alright, so that is a conservative target. 80% of the time, 90% of the time, you will hit the 1.618% and you will get out of that trade. Me personally, I work with a 2.618%, and I will teach you that guy within the next 10 or 20 minutes. If you get there, I will show you a little bit of Elliott wave principle. So as you continue with the beginners class, you will get more skilled, and I will go then with you to the Elliott wave principle, which then we will target the 2.618%. Ian, I know. Postman, you know. Michael, you also. You know the Elliott wave principle. Just quickly, if we've got our 1 and 2 in place, our 3 will be at the 2.618%, and you will see there very close our wave 3 made a 4, and we just continue there. The same as this one. We can test that quickly. We have our 1, 2 in place, and look at that 1.2618% extension. That's our wave 3. Alright, so I delete that. So that's our Fibonacci retracements. We want to buy in the bull market, and we want to target the 618% extension. And if we're in a bull market, we already run past the point A and B and C. If we want to buy again, if the market only retraces to the 618% extension down here, remember this is my 38.2, it's in reverse, I will only target the 127. So if I come down with a shallow retracement, I know the extension will be shallow, I will only target the 127. Right, let's go down to the British pound again. This is the 38.2%. In other words, the market has a swing there from 2 to 3. We want to sell in the direction of the trend. We know that the market has already run a few pips, few hundred pips. This market is almost complete, and because it's almost complete or tired, it will retrace shallowly, and we will sell the 38.2%, and we will target the lows down here, which is my 127. So let's see in this example which area I will target. If I sell the 38.2% there, I will target this 127%, and that is at 45.30. Right, deep retracements, big targets, shallow retracement, shallow targets. I want to do the Fibonacci's of triangles that can be seen on the weekly, on the daily example on the yen, and I will also use the Canadian dollar. Because triangles is contracting, most of the time my Fibonacci levels will be the 78.6%. In other words, if I've got my leg down, that you can see is a bounce at the 78.6%. If I got that level, if I've got that leg, and I draw my Fibonacci from this leg in, you will also see a 78.6% retracement there. And now we use the following leg, that one, and you will see the legs are getting smaller and smaller, and the deeper we go into the triangle, you will see 78.6% retracement levels as we go along. You can test this leg down up here. Come on. Again, 78.6% retracement. So if you're in a triangle, we know that the price is contracting. You will have 78.6% retracement until the market breaks out of that 78.6 and you go in the direction of the trend. Is that clear? Another example is on the Canadian dollar. This, to me, I want to see if this is a bullish or a bearish triangle, but you will also see, if you draw in your Fibonacci's of each leg, you will see the 78.6% retracement there to that leg. You will see this is a very deep leg there. Most of the time it will go 78.6%. Alright, Ian's got a question, so that should be the case for waves 2 and 4, A and C. Yes, Ian, correct. We will do that next week. Wave 2 will be on the 618% and the 4 will be on the 38.2%. Alright, if that is your question. And A and C, remember, yeah, that Fibonacci I will do with you on next week, the ABC, because this is a beginner's class. I will get to that with Elliot. But yeah, 2 will be 618% and 4 will be 38.2%. Alright, is there any questions at this point for the guys that do not understand how Fibonacci works at the moment? We'll go to in examples now. We will also do this little green tool here, which is a very nice extension tool of the Fibonacci we can work with. Michael's got a question. Do you always employ Elliott wave analysis together with Fibs in a trending market? I always use Elliott wave and I always use Fibonacci's. Yes, Michael, if that's a question, always use Elliott wave and I always use Fibonacci. Fibonacci is a very nice tool because this lesson is about Fibonacci for the beginners. I will not cover Elliott wave. I will just throw quickly, I know there's a few advanced guys here, I will just throw in some advice with the Elliott wave. Alright guys, look at this swing. This is the euro. Obviously this is a bear market. We're still in this bear market. So how do we determine where we'll put in the Fibonacci's of this one? Guys, you can mark your highs and lows or your resistance and support levels, and you can draw Fibonacci from that certain resistance in this example. So is it correct if I draw my Fibonacci? This is a bear market. Alright, we can see there the market didn't even get from that high there, from that swing high, that red one. That is a high. I can draw my Fibonacci from there. that market didn't even come to the 38.2%. That's a very shallow retracement, and the market just fell. In this example, we can see the high here. That is my high. That is my B. And this is my C. Guys, that is quite correct to draw your Fibonacci in the direction of the trend, and you can sell there on the 618%. In this example, that you will sell. We had an A, B. In other words, we worked with that high. That resistance level was my swing high. We call it the swing high or resistance. We had a down move from A to B. We're in the bearish market here, and we retraced to the 618% in extension. We can sell that market with our stops above that red line there, and we will target down here. So let's look at our target. To find the target, we draw the Fibonacci in the opposite direction. Because it has bounced from the 618%, we can target the extension down here, C, and that target is around 380, 1.0380 on the euro. You will sell there, stops above the high, and you target down here. Can you see in this market, if I delete this Fibonacci, if I didn't have this tool, that there's no way that you will know that this market, why this market has turned there. You got lower highs, all right. We can draw maybe a trend line there. We've got lower lows, but this one is actually a higher low. But if I draw my Fibonacci incorrectly in the direction of the trend, we know why this market has turned around there, because that was a Fibonacci level. Now what you want to do is you want to put in some indicators and trend lines to confirm what you are seeing. Now on the South African Rand, there's a very nice example. For the guys that can remember, a few weeks ago there was a question. I can't remember who it was. He asked to look at the Rand, and I said you must buy the Rand. I will not sell it. And why is that? Because I know we're in a bullish market. We're going upwards because of this, all the mines. And we were at around, it was a few days ago. The Rand was up here. I suggested to buy the Rand on the 618% extension. That was an up run from that low. That is our A, and we draw it into the B and look at that C, which was on the 786% extension. We're in the bullish market. This is on the trend line. If you draw a trend line down over those lows, over that low, that is very close to the trend line. We're in a bullish market. The market came down. Look at the strong bull market. We know that was a retracement by the 7.8%, and we're going up. Ian, thank you very much. Ian said this is the most informative lesson on Fib levels. Then I'm very glad, Ian. This is why we are doing it with GFI, is that you guys can trade profitably and you know how the market works. Alright, 78.6%, you can also target the 618%, 1.618. So look at this Rand, just this little run here. This is our A. This is our B. We will go to more examples now, guys. Bullish market, we're looking for a run in the direction of the trend, and we're looking for a retracement. Let's go to the 4-hour chart. For the guys that know, this is a corrective wave. See how and the lows and the highs are overlapping. This is a three-way move. This is a corrective move. We want to buy in the direction of the trend. We want to buy the Fib zone or the 618% in the direction of the trend. Alright. Stops down here. Stops will be below A. And for now, for this example, I will draw my Fibonacci in the other direction to find my target. Alright, so we know that this was my 78.6%. we will be targeting only the 1.618. So if you bought down here on C, you will target D. There will be your take profit. There you have the complete run. I believe the South African rand will still weaken, or the dollar will appreciate. We bought C, only targeting the 1.618. Alright, that is a complete Fibonacci retracement level bought. Stops down here and you will target up there. Let's get some example on the euro. I want to show you guys how Fibonacci levels can overlap. We call it Confluence, and I want to show you how to use that. But before we get there, let's get to this little tool here, Fibonacci extensions. Guys, this is mostly for corrective waves. I'll always put in my 100%, 127, there's my 1618% again, and let's delete that to 100%, and I will show you how this works. This is another tool. I will add the two now together to see. So this little blue one, the normal Fibonacci, you will use in impulse waves to get the ABC to buy the Fibonacci retracement, and the green tool, you can make it green on your settings, or the Fibonacci extensions, is what you will use in corrective waves. Alright, here's an example. For the guys that knows corrective waves, this is a corrective wave or a three-wave move. We also call it, I'm going to write it down here, AB equals CD. In other words, my legs are equal to each other, or in Elliott wave principle, we call it A equals C. My A wave will equal my C wave. So from the top here, this is my first leg. We delete that. Guys, just bear with me. The more examples I will use, the more you will know what's going on. I will do it like this. That's my first leg. We've got a retracement there, and this is my second leg. 80% of the time, those two legs in a retracement level or corrective wave. Remember, corrective waves are overlapping. 80% of the time, those legs will be equal. So that you can use from the top to the bottom. Alright, we've got a down leg, and now you put this zero line at the top there. Alright, now you will know where 100% extensions are. In other words, there's the place or the point where this leg, if I just draw it like this, will be equal to my previous leg. Alright, happy with that? We will go to examples now. In other words, it will look like this. I will find example for you in the market in a few minutes time. Just give me a second. Just for as while we're down here, can you see how I see that this market has gone already? This was the top, or the top of our market. That was our AB move. Do you see how the market retraced here to the 618% extension? That was a deep retracement. And as the market went along and made a low, now I know that the market won't retrace as deep. Look at this high here. The market only came to the 618%, to the 38.2% here. Look at that retracement there. It's a shallow retracement. So now this market has fallen quite a bit, and it's almost complete. This market is tired, so I suggest this market will only go and retrace to the 38.2%. This market won't go back to the 618%. If that goes beyond the 618% extension, we know that this market has turned and we're in a bullish market. Alright, Khomotso, you've got a question? You've got signal problems, you're breaking. Yes, this lesson will also be on YouTube in a few weeks' time. All the lessons are on YouTube, and then the audio obviously will be fine because it's recording from my headset directly to my PC, and it's not using the signal. Alright, so if you've got a bad signal, just quickly go and log out and log in again, and maybe then it's fine. Alright, you can see this example on the Australian dollar. This is what I want to use. Just want to pause here. Alright, we've got some problems. I'm going to log in again. Alright, I've got and we're stopping this for a while, and we will just continue a few minutes.